Here's a summary of Caterpillar's Q2 2026 earnings call, designed for clear and concise delivery. Begin recording announcement. Welcome to the second quarter 2026 Caterpillar earnings conference call. I would now like to hand the conference over to your speaker today, Alex Capper. Thank you. Please go ahead. Thank you, Audra. Good morning, everyone, and welcome to Caterpillar's second quarter of 2026 earnings call. I'm Alex Capper, Vice President of Investor Relations. Joining me today are Joe Creed, Chairman and Chief Executive Officer, and Kyle Epley, Chief Financial Officer. We'll be discussing our second quarter results and then taking your questions. Let's turn the call over to Joe Creed for his opening remarks. Joe Creed, Chairman and CEO. Thanks, Alex, and good morning, everyone. Thanks for joining us today. This quarter, Caterpillar achieved a significant milestone. Sales and revenues reached a record $20.5 billion, up a remarkable 24% versus the prior year. This is the first time in our company's history that we've surpassed $20 billion in a single quarter, a testament to our customers' essential work and our employees' dedication. We delivered adjusted profit per share of $8.17, a substantial increase of 73% year-over-year. Our backlog also saw robust growth, increasing sequentially by $9 billion to a record $72 billion, up 92% compared to last year. This strong order rate and growing backlog reflect broad momentum across our business. Operationally, we generated robust MP&E free cash flow of $5.1 billion in the quarter and returned $2.2 billion to shareholders through repurchases and dividends. Looking at our segments, Power and Energy saw sales to users grow a strong 33%, driven by data center demand for large gensets and turbines, and also by gas compression applications in oil and gas. Construction Industries continued its positive trend, with sales to users up 22% for the sixth consecutive quarter. This was fueled by strong rental fleet loading in North America and demand from non-residential and residential construction. Resource Industries delivered a solid performance with sales to users up 17%, supported by mining, heavy construction, and quarry and aggregates. We've also been active in strategic initiatives. In Power and Energy, we are resuming production of our 10-megawatt medium-speed gas reciprocating engine to meet growing demand, expecting to bring about 1.5 gigawatts of capacity back online by the fourth quarter. For Construction Industries, we successfully delivered our first units to major projects, a new dealer-owned rental joint venture focused on large-scale infrastructure projects. And in Resource Industries, we've completed the acquisition of Skycatch, further enhancing our technology offerings alongside the recent RPM Global acquisition. Kyle Epley, Chief Financial Officer. Thank you, Joe. Good morning, everyone. I'll provide a more detailed overview of our financial results and outlook. As Joe mentioned, sales and revenues were $20.5 billion, up 24% year-over-year, exceeding our expectations. This was primarily driven by stronger sales volume across all three segments and favorable price realization. Adjusted operating profit was $4.5 billion, with an adjusted operating profit margin of 21.9%, both better than anticipated. A significant factor impacting our margins this quarter was tariff recoveries, specifically $392 million in IEEPA tariff recoveries, with the majority reflected in corporate items. Excluding these recoveries, our tariff costs for the quarter were approximately $400 million, which was lower than expected due to favorable adjustments to previous calculations. These tariff costs impacted segment margins across Power and Energy, Construction Industries, and Resource Industries. Our adjusted profit per share came in at $8.17, also above our expectations. For the quarter, MP&E free cash flow was a record $5.1 billion. Joe Creed, Chairman and CEO, continued outlook. Turning to our outlook, we continue to see strong momentum in our end markets. We are increasing our full-year 2026 sales and revenues expectations to mid to high teens growth. This improved outlook is supported by healthy demand across all segments, our progressing capacity expansion plans, and the breadth and duration of our record backlog. We anticipate stronger full-year growth across all three primary segments compared to our previous outlook, with services revenues also expected to grow at a higher rate. We expect to see stronger performance in the second half of the year compared to the first half. Regarding adjusted operating profit margin, we now expect the full year to be higher than previously anticipated, reflecting the improved sales outlook. Excluding the Q2 IEEPA tariff recoveries, we expect the full-year adjusted operating profit margin to be near the bottom of our target range. We are confident in our ability to manage the impact of tariffs over time and aim to operate around the midpoint of our target range. Furthermore, we are increasing our MP&E free cash flow expectations to be in the top half of our annual target range. Looking at our key end markets, power and energy, we anticipate continued strong demand in power generation, driven by data center growth and AI, and moderate growth in oil and gas, particularly in gas compression. Construction industries, we expect full-year sales to users growth, supported by healthy construction spending, including IIJA funding and non-residential investment. We anticipate continued dealer rental fleet loading. Resource industries, we foresee increased sales to users, driven by demand for copper and gold, and positive dynamics in heavy construction and quarry and aggregates. Rail services and locomotive deliveries are also expected to grow. Kyle Epley, Chief Financial Officer, continued outlook. For the third quarter, we anticipate another strong quarter of sales growth year-over-year, with volume increases and favorable price realization across all segments. We expect year-over-year impact from dealer inventory to be a modest headwind to sales volume in construction industries. For the full year, as Joe highlighted, we now expect mid to high teens sales and revenues growth. We expect strong sales growth across each primary segment, mainly driven by volume and price. We anticipate a more typical reduction in construction industries' dealer inventory in the fourth quarter. Our full-year adjusted operating profit margin will be higher than expected in April due to the increased sales outlook. Excluding expected IEEPA tariff recoveries, the margin would be near the bottom of the range. We now expect full-year 2026 tariff costs of around $2.2 billion, at the low end of our previous range. Our outlook does not include any additional IEEPA tariff recoveries in the second half. We continue to expect restructuring costs of approximately $300 million to $350 million. Our estimated global annual effective tax rate remains approximately 23%. With the improved sales and adjusted operating margin outlook, we now expect MP&E free cash flow to be in the top half of our annual target range of $6 billion to $15 billion. Summary of key financial metrics. Revenue, $20.5 billion, Q2 2026, up 24% year-over-year. Mid to high teens growth expected for full year 2026. Profit, adjusted profit per share of $8.17, Q2 2026, up 73% year-over-year. Full-year outlook for adjusted operating profit margin is higher than previously expected. Gross margin, adjusted operating profit margin was 21.9%, Q2 2026, up 430 basis points year-over-year. Backlog, $72 billion, Q2 2026, up 92% year-over-year. Free cash flow, MP&E free cash flow of $5.1 billion, Q2 2026, a record. Full-year expectation increased to the top half of the annual target range. Management's forecasts for future quarters, Q3 2026, expect another strong quarter of sales growth, with volume increases and favorable price realization in all three primary segments. A modest headwind to sales volume in construction industries from dealer inventory is expected. Full year 2026, mid to high teen sales and revenues growth. Stronger performance expected in the second half. Adjusted operating profit margin and MP&E free cash flow are expected to be better than previously guided. Significant risk factors, geopolitical events, ongoing uncertainty due to geopolitical events. Tariffs, continued impact and fluidity around tariffs, although mitigation plans are in place. Supply chain, while improving, ongoing global supply chain dynamics can still present challenges. Economic conditions, softer economic conditions in Asia-Pacific outside of China. Highlights, record Q2 sales and revenues of $20.5 billion. Record adjusted profit per share of $8.17. Record backlog of $72 billion. Record MP&E free cash flow of $5.1 billion. Resumption of 10-megawatt gas reciprocating engine production. Launch of major projects rental joint venture. Acquisition of Skycatch to enhance technology capabilities. Increased full-year sales, profit margin, and free cash flow outlooks. Lowlights, softer economic conditions in Asia-Pacific outside of China impacting construction industries. The Middle East continues to be challenged for construction industries, although the overall impact on EME sales to users is anticipated to be limited. Higher SG&A and R&D expenses due to strategic investments, although this is viewed as necessary for long-term growth. Most important statements from CO and CFO CEO Joe Creed. This milestone underscores both the essential work our customers do every day and the dedication of Caterpillar employees worldwide to solving our customers' toughest challenges. He emphasized the company's ability to respond to customer needs and turn opportunities into profitable growth, highlighting their strategic investments and commitment to operational excellence. He also expressed confidence in managing tariff impacts and capitalizing on strong end-market demand. CFO Kyle Epley, our balance sheet remains strong. We have ample liquidity with an enterprise cash balance of $6.7 billion. He provided clarity on the financial impact of tariffs and highlighted the record cash flow generation as a key indicator of financial health. He also reiterated the company's commitment to returning free cash flow to shareholders. Conclusion: with broadening momentum across all three of our primary segments, we'll remain focused on operational excellence and delivering for our customers to create long-term value for our shareholders. With that, we'll now take your questions. End of summary.